Imagine this. You put $10,000 into 2 ETFs, and instead of just hoping the stock market goes up, you've got a strategy designed to generate weekly income whether tech stocks are climbing or crashing. It almost feels like cheating the system. But here's the reality. This strategy can create steady cash flow in certain conditions, and it can also disappoint badly if you don't understand the moving parts. That's what we're unpacking today. We're going to look at whether combining MSTY and SLTY makes sense, what these funds really do, where they can shine, and where they can let you down. I'll also walk you through a simple example of investing $10,000 and what that might look like after 1, 5, and 10 years. By the end, you'll know whether this combo fits into your portfolio or whether you're better off steering clear. Before we dive deeper, make sure to subscribe to Money Quest Broker so you don't miss these breakdowns. We explore the strategies investors are really talking about right now, with real numbers and no hype. So let's set the stage. MSTY is short for the YieldMax Magnificent 7 Total Yield ETF. It's built around the so-called Magnificent 7 stocks: Apple, Microsoft, Tesla, Nvidia, Amazon, Meta, and Alphabet. These are the tech giants that have driven much of the market's growth over the last few years. Instead of just buying and holding these names directly, MSTY uses a covered call strategy. That means it owns exposure to these stocks, but then it sells call options on them to generate extra cash flow. The result? Income for investors, but with a trade-off: you give up some upside if those stocks rally too much. SLTY, in contrast, plays the opposite side of the fence. Its name is short for YieldMax UltraShort Option Income Strategy ETF. Instead of being tied to the long side of tech, it has a bearish tilt. It earns income from option strategies that are positioned to benefit when tech stocks and the Nasdaq struggle. In other words, SLTY is designed to shine when markets pull back or when volatility spikes. That's why people are starting to think about combining the two. MSTY thrives in bullish conditions, SLTY thrives in bearish conditions. Together, they seem like a way to collect weekly income whether the market is hot or cold. Imagine having one income stream that works when the bull is running and another that works when the bear comes out of hibernation. That's the appeal. But here's the thing, it's not that simple. These funds are not perfect opposites. Sometimes both can struggle at the same time. If markets get stuck in a low volatility sideways period, neither strategy may produce strong income, and your share values can slip lower while you wait. Another big risk is something called NAV erosion. NAV stands for net asset value, the underlying value of the ETF itself. Over time, if the option strategies don't perfectly balance the payouts with market movements, the share price can slowly bleed lower. That means even if you're collecting juicy weekly income, your original investment could shrink. For example, $10,000 might generate income, but could be worth only $7,000 or $6,000 a few years later if erosion kicks in. That's why these ETFs should be seen as income tools, not long-term wealth builders. Okay, let's walk through a clear example together. So, say you invest $10,000 and split it evenly, $5,000 into MSTY and $5,000 into SLTY. We'll use estimated annual yields here, about 12% for MSTY and about 15% for SLTY. Just keep in mind these are assumptions, not promises. The actual numbers can move around based on market conditions, volatility, and, how well the strategies perform. After 1 year, MSTY could pay you around 12%, which works out to about $600. SLTY at 15% could pay about $750. Put them together, and you've collected about $1,350 in income. That means your $10,000 could turn into roughly $11,350 after year 1. Assuming NAV holds steady. Now let's stretch this out to 5 years. If you reinvest all of that income back into the funds, the compounding effect really starts to kick in. After 5 years, your $10,000 could grow to around $18,800, and after 10 years, with reinvestment, that same $10,000 could reach about $35,700. That's more than triple your original investment. But here's where a little caution comes in. Those numbers assume NAV doesn't erode. If the share prices decline by just 3 to 4% each year, the totals drop significantly. Instead of $35,000 after 10 years, you might only see $20,000 to $25,000. The income is still there, but the value of your shares has leaked away over time. That's the trade-off with high-yield, option-based ETFs like these. Big payouts, but potential long-term drag. So, is combining MSTY and SLTY a good idea? Well, the answer really depends on your goals. If you're looking for weekly income and you like the idea of having exposure on both sides of the market, bullish and bearish, then yes, pairing them can make sense. It's a way to sort of smooth out your cash flow across different conditions. But if you're looking for a reliable, long-term growth engine, then no, these aren't replacements for core holdings like VOO, SCHD, or VT. They work better as side strategies, not the foundation of your portfolio. Think of it like this: if your portfolio is a house, ETFs like VOO and SCHD are the concrete foundation. MSTY and SLTY are more like add-ons, a porch or a sunroom. They can make the house more comfortable, but you wouldn't want to build the entire structure on them. Another smart way to use them is tactically. Maybe you lean a little more into MSTY when markets are bullish and shift some weight into SLTY when volatility picks up. Or maybe you just hold a small percentage in both to capture income without risking too much capital. At the end of the day, these funds are tools. They can deliver attractive income if you understand how they work, but they require active thinking. They're not the kind of ETFs you buy once and forget about for 30 years. So what do you think? Would you combine MSTY and SLTY for weekly income, or do you see them as too risky for your style? Drop your thoughts in the comments. I'd love to hear how you're approaching it. And if you found this breakdown helpful, don't forget to subscribe to Money Quest Broker for more deep dives into income ETFs, strategies for balancing risk, and the real math behind investing. This video is for educational purposes only and is not financial advice. The numbers shown are hypothetical examples, not guarantees. Always do your own research or talk to a licensed financial advisor before investing.